You've been hearing the same lie since you were 5 years old. Like, renting is throwing money away. You've been conditioned to believe that a house with a white picket fence is the ultimate finish line of the American dream. But here's the reality that hits you at 3 a.m. when the heater breaks down in the middle of January. You didn't just buy a house, you took on a 30-year leveraged financial commitment that may be the biggest obstacle to your freedom. There's a specific mathematical limit, what I call the 8.71% dead zone, beyond which buying a house doesn't generate wealth. Instead, it actively erodes your wealth. Most people see their home as forced savings. In reality, for the first 10 years, it's a wealth destroying machine that the banking industry has spent billions of dollars selling as security. Today, I'm going to leave aside all that emotional nonsense. Let's analyze the phantom costs that the bank conveniently omits from its mortgage calculator. I'm going to show you the exact number at which your brain stops owning a property and becomes a slave to debt. In a moment, I'll reveal the secret your loan officer hopes you never see. The one that proves why your investment might actually be a $200,000 mistake. But first, we need to understand why your brain is biologically programmed to fall into the homeownership trap. Let's talk about the math your bank hides in the fine print of that 30-page mortgage document. Most people think they are buying a $500,000 home. They aren't. They are buying a debt product that happens to have a roof. If you buy a $500,000 house with 20% down at a 7% interest rate, your monthly principal and interest is roughly $2,660. Over 30 years, you will pay the bank $958,000. That is nearly $1 million for a $500,000 house. You are effectively buying one house for yourself and nearly an entire second house for the bank's shareholders. But it's worse than that. Let's look at the amortization schedule. This is the document your loan officer hopes you never actually read. In the first year of your mortgage, out of that $2,660 payment, only about $330 goes toward your principal. The other $2,330? Gone. Straight into the bank's pocket as interest. You aren't building equity in those early years. You are paying a permission fee to exist in a space you don't yet own. You are effectively renting the money. But unlike a renter, you are the one responsible when the sewage pipe bursts at 2 a.m. on Christmas Eve. This brings us to the phantom costs. In the real estate world, we have a benchmark called the 1% rule. On average, you will spend 1% of your home's value every single year just on maintenance and capital expenditures. On a $500,000 home, that's $5,000 a year, or $416 a month. That simply evaporates. It doesn't add value. It just prevents the value from dropping to zero. It's the cost of entropy. Now, add property taxes, which average 1.1% nationally but can be much higher, and homeowners insurance. Suddenly, your affordable $2,660 mortgage has ballooned into a $4,000 a month monster. Now, stop right there. If you're sitting there thinking, okay, Nick, so I'll just save up a bigger down payment or find a fixer-upper and I'll be fine, you've just walked straight into the first major trap. Most people think the goal of the game is to have a house because they've been told it's the bedrock of the middle class. But here's the brutal truth. The middle class is a trap designed to keep you productive but never truly free. There is a massive, life-altering difference between having money and being wealthy. What I'm about to tell you now is what differentiates the people who retire at 45 with a $5 million liquid portfolio from the people who are still house-rich and cash-poor at 70, praying the real estate market doesn't dip so they can sell their home just to afford a decent nursing home. If you think your primary residence is your best investment, you aren't playing the game of wealth. You're playing the game of social signaling. You are buying a trophy before you've won the race. Let's look at the ghost math that haunts your bank account. Opportunity cost. Imagine neighbor A and neighbor B both have $100,000. Neighbor A puts that $100,000 down on a $500,000 house. That money is now dead capital. It is locked in the drywall. To get it back, neighbor A has to either sell the house and pay 6% in realtor fees, or take a loan against it and pay more interest. Neighbor B decides to rent a similar house. It's not throwing money away. It's buying mobility and liquidity. Neighbor B takes that same $100,000 and puts it into a boring, low-cost S&P 500 index fund. Historically, the stock market returns about 10% annually, 7% after inflation. Real estate, after you subtract maintenance, taxes, insurance, and interest, historically struggles to beat inflation by more than 1% or 2%. In 30 years, neighbor A owns his home free and clear. If it appreciated at 3% a year, it's worth about $1.2 million. Sounds great, right? But neighbor B's $100,000 investment? Without adding a single penny to it, at a 10% return, it has grown to over $1.7 million. Neighbor B is liquid. Neighbor B can move to Switzerland tomorrow. Neighbor B has nearly $500,000 more than neighbor A simply because he didn't fall for the pride of ownership trap. Neighbor A has a big house, but neighbor B has total autonomy. The banks love to tell you that homes always go up. And they do, nominally, but they rarely tell you about the real return. When you factor in the $20,000 you spent on the kitchen remodel, the $15,000 for the new HVAC, and the $150,000 in property taxes over 30 years, most homeowners actually have a negative real return. But why does it feel so right to buy? It's because of a psychological phenomenon I call the sunk cost sanctuary. Once you spend $10,000 on a new deck, your brain refuses to admit the investment was a poor use of capital. You start overvaluing the home to protect your ego. You tell your friends, "My house went up $100,000 this year." But you conveniently forget the $40,000 in interest and repairs you paid during that same time. You become a prisoner of your own pride. You stay in a job you hate because the mortgage is a must-pay. You turn down a 20% raise in another city because the hassle of selling is too much. You have traded your career velocity for geographic stagnation. But it gets even deeper. Many of you are suffering from what I call the Effeto glass wall, the glass wall effect. It's the phenomenon where your net worth looks amazing on paper, but your daily life feels like you're struggling to survive. You have $400,000 in home equity, but you're stressed about the price of eggs. That is not wealth. That is a gilded cage. In exactly 60 seconds, I am going to give you the step-by-step freedom filter. This is the exact mathematical framework I use to determine if a property is a wealth generator or a wealth killer. But before I give you the formula that will change how you look at every for sale sign forever, you need to understand the lifestyle mirage. The hidden reason why buying a house actually forces you to spend more money on things that don't even make you happy. We're at the 7-minute mark, and as promised, I'm giving you the keys to the kingdom. If you're still watching, it's because you realize that common sense is often just common poverty. You want the truth. This is the freedom filter. It's a 3-step mathematical gauntlet that every property must pass before you even think about signing a mortgage. If a house fails even one of these, you aren't buying a home. You're buying a financial anchor. Step 1. The 5% rule. Ben Felix, a legendary financial researcher, popularized this, and it's the ultimate rent versus buy tiebreaker. Calculate 5% of the home's total value. Divide that by 12. If you can rent a similar house for less than that number, buying is a mathematical disaster. Why 5%? Because 1% is maintenance, 1% is property tax, and 3% is the cost of capital, the interest you pay or the investment returns you lose. If you're looking at a $600,000 house and 5% is $30,000 or $2,500 a month, and you can rent it for $2,200, you are literally being paid $300 a month to let someone else handle the plumbing. Step 2, the mobility premium. Can you commit to this exact zip code for the next 10 years? If the answer is maybe, or I hope so, the answer is no. The transaction friction of real estate is a wealth killer. Between closing costs when you buy and the 6% commission when you sell, you lose roughly 10% of the home's value just by moving. If you move twice in a decade, you've evaporated your entire down payment in fees alone. Step 3. The liquidity ratio. Will your total housing cost, PIDI plus maintenance, be less than 25% of your take-home pay? Most banks will lend you up to 43%. That is a trap. The bank wants you maxed out because a desperate borrower is a consistent payer. If you cross that 25% line, you enter the equity trap. But there's a deeper psychological reason why houses keep people poor. I call it the lifestyle mirage. When you rent a 2-bedroom apartment, you buy a couch that fits. When you buy a 4-bedroom house, you suddenly need to fill those empty rooms. You need a lawnmower, you need a pressure washer, you need a statement rug. This is the Diderot effect on steroids. One purchase, the house, creates a spiral of consumption to make the rest of your life match the house. You start hanging out with neighbors who drive $80,000 SUVs. You start feeling cheap if your landscaping isn't as manicured as theirs. The house doesn't just take your money through interest. It reprograms your brain to become a world-class consumer. You stop asking, how much wealth can I build? And start asking, does this patio set look like I've made it? This is the part that hits the hardest. Your relationship with your house changes your relationship with your boss. When you have $200,000 in liquid cash and you're renting, you are dangerous. You can walk into your boss's office and demand a raise. You can quit and spend 6 months starting that business you've always dreamed of. You have walking away money. But when you have a $4,000 mortgage payment and $2,000 in the bank, you are docile. You are a safe bet for the corporation. You will take the extra work. You will tolerate the toxic manager. You will stay in the cubicle because the mirage must be fed every 30 days. The bank doesn't just own your house, they own your ambition. They've traded your potential for a 30-year fixed-rate cage. Here's the biggest insight of this entire video. True wealth is not about what you own. It's about what you can do. If owning a home makes you feel secure, that's fine. But don't call it an investment. Call it a luxury purchase. It's a hobby that you live inside of. Real investment is capital that works while you sleep. A house is capital that sleeps while you work to maintain it. If you've made it this far, you're part of the 1% who actually wants to understand the mechanics of money rather than just following the herd. I make these videos to give you the unfair advantage the school system ignored. If you want to see the specific breakdown of how I invested my first $100,000 instead of buying a house, hit that subscribe button and turn on notifications. We're building a community of people who value freedom over furniture. So, is buying a house a mistake? Mathematically, in today's market, often yes. But the real mistake isn't the house. The mistake is believing that the path everyone else is taking is the only path to the top. The bank shows you the dream because they want your interest. I'm showing you the math because I want your independence. Don't buy the lie until you can afford the truth. Stop being house rich. Start being world free. I'm Mr. Pengo. Thanks for watching. I'll see you in the next one.